Good afternoon, traders and investors. Will back here with another one. Happy Thanksgiving to all of you. Hopefully all of you are having a very nice holiday period right now, and welcome back to the channel. In today's video, guys, we are going to cover a very hot topic. Have the markets topped out? Is everything too good to be true? We know that a lot of stocks have been flying a lot higher, especially some of these small growth names that have been pretty much dead for the last 2-3 years, now flying 20, 30, 40% just in a few short weeks in terms of since the election. Now, obviously, there's a lot of concerns right now, and there's a divergence in the market between the bull market thesis of continued expansion and continued growth and the broadening out of the market, and then the bear thesis, which says things are too good. There's some cracks in the underlying economy that people are ignoring, and that we're possibly going for a deep recession that could come as early as 2025. So in today's video, we are going to address a lot of the concerns surrounding the bear market thesis, the market crash thesis, and all of that in between. And I will give my opinion on whether or not a lot of these points are valid points, logical points, and whether or not we could possibly be heading into a recession and when that may simply come, or whether or not this is still a very good time to be buying high quality companies, adding to your portfolio, and why we might potentially see a continuation of the bull market into 2025 as opposed to having a recession. So in terms of the points that we're going to cover today, guys, you will see that it is a lot of them, and with good reason, because there are a lot of concerns in the market right now. So here we go. We're going to go through all of these points, spend a couple minutes on each point, and I will give you my opinion on each one. And as you should notice, guys, even though there are these red flags, the data interpretation is not so clear right now. It is not a clear-cut fact that we are going to have a market crash or a recession. All of these data points are open to interpretation, but we cannot ignore them. So let's get started right away. And the chart that I put them on, guys, fitting enough, is on IONQ, a stock that since the 1st of October right now, from towards the highs, is up 3.5x, almost 4x from the bottom, guys, right? So what better chart to do it on than a company that really doesn't make that much money at all? They hemorrhage money every single quarter in terms of being net income negative, and yet still a quantum computing company without that much revenue to show. The bull market has taken over at this point and is up 4x in a short amount of time. You can find so many of these different stocks, guys, stocks that have been left for dead for the last 2-3 years that have all recently come alive, coming up 20, 30, 40% in the last 2 months worth of trading, which leads a lot of people to believe that there is too much greed in the markets right now. When the small caps are igniting, when the meme stocks are igniting, it symbolizes a late stage cycle bull market. You can see it in the price of Bitcoin as well. Bitcoin almost at 100,000 right now. So when you have a rally of risk on assets, sometimes it's synonymous with the end of a bull market cycle, but other times it's synonymous with an expanding and broadening bull market. So let's take a look at a few of these points and see if we can shed some light on the topic. So number one, of course, we have to talk about this one. Unemployment will skyrocket. In terms of the bear market crash thesis, this is the most important part of all. We know that consumer discretionary spending has been relatively weak, especially in the last year, because consumers have been dealing with a lot of inflation over the past 2 years, and the Federal Reserve keeping interest rates high at around 5.5%, at least for the last year and a half, has definitely not helped and has been squeezing people's buying power. However, we have to understand still that we are the context right now of a historically low unemployment rate. Take a look right now, unemployment rate is about 4.1, and if you take a look at the last 20, 30, 40 years, you will see that in terms of historical averages, these are very low numbers. Now, we have upticked from the bottom by more than 0.5%, and that has triggered something called the Sahm rule, which is states that whenever you get a 0.5% increase in unemployment from relative lows, usually that is synonymous with a recession. However, it's not so simple, and we will take a look at an excerpt, a clip from Claudia Sahm herself, who developed this rule, as to how this time may just be different. But for now, that'll be later on in the video, but for now, unemployment rates are still at record lows. Now, if these start to uptick in a very wide and fast fashion, then we can possibly expect some more recessionary pressures on the economy. Of course, the Federal Reserve has tools to counterbalance this, by decreasing rates to accommodate the economy and resort to measures such as quantitative easing to kind of backstop the market in the event of any crash. So the Fed does have some tools, but as of right now, unemployment uptick from the lows, yes, but still within very low levels in terms of historical average. So as you can see, guys, the data for the unemployment rate is still not so clear. So that's point number one. Number two is the Fed is too late and the damage is done. This has to do with the whole hard landing versus soft landing versus no landing scenarios, right? If you listen to Jerome Powell, at least over the last 2-3 months, every single interest rate decision cycle that he's given so far in terms of press conferences, the Fed is very confident that not only is it in line with expectations right now and that they are not too late, but they are very confident that they have managed, as they call, the balance of risks, right? There's a risk of decreasing interest rates too fast, which could lead to a resurgence of inflation because you're basically telling people, we're going to cut interest rates really, really fast, so go out and spend more money, right? That is a problem. But there's also another risk on the other side, which is if you wait too long to decrease interest rates, you put too much pressure on the consumer and it might be too late. As of right now, although there are some cracks in the economy, businesses appear to be managing these tough economic times fairly well. We just got all of the Q3 earnings and I covered a lot of them on the channel, and none of them are really guiding for dwindling profits or decreasing year-over-year EPS, which would be synonymous with a recession and which would point to the fact that the damage is indeed done to where these companies do not have pricing power anymore and to where they cannot access capital markets to obtain more debt. So far, that is not the case. So is the Federal Reserve too late? Is the damage done too much? I do not think the data is clear on that point. At least we do not see it in corporate earnings. And from the Fed's language and positioning as well, analysts do not expect that either. They do still expect the quote unquote Goldilocks scenario, which is a soft landing or no landing scenario. And the data does still point to that fact. Number three is a big one, of course. People saying that the data is fake. Obviously, we know that inflation measured by CPI and PCE have been on a decent downtrend. The jobs market is still relatively resilient, but the economic output, the manufacturing sector, that is a little bit of a problem. But people constantly say that the data is possibly fake. And it might just be fake, guys. However, it's not going to be fake by a factor of 2, 3, 4, 5x, right? If anything, the data might be a little bit fake in terms of how they measure these things and the baselines that they use, but we can derive certain trends, right? So in terms of what we're going to be looking at right now is the non-farm payrolls, the jobs market as a whole. As you can see, we've been constantly adding jobs to the economy. So although the non-farm payroll numbers have been slowing down in terms of how many jobs we add to the economy, we don't have a lack of jobs to begin with, to say the least, right? Here is your total employees as measured by the total non-farm payrolls by the Federal Reserve, here at Federal Reserve Bank of St. Louis this time. And you can see that we are not in a employment crush cycle as of right now. In terms of the historical norms, how much jobs we usually add on a monthly basis, take a look at prior to the pandemic, the 10-year span between 2012 and 2020. You can see that on average, every single month, we add anywhere between, let's call it a midpoint of about 100,000 to 200,000 jobs. And I'll just bring my cursor back. You can see that that's always the case every single month. Some months higher, some months lower, but on average, always between 100,000 to 200,000 jobs are added to the economy as measured by the non-farm payrolls. The reason that people are concerned right now is because we've had a slight downtick. Well, not a slight, a very large downtick since the heights of 2021 and 2022 when the economy was adding all the jobs that were lost during the COVID period, right? A ton of jobs lost, a lot of workers laid off, a lot of part-time workers laid off. Then they rehired the entire workforce when the economies were opened up again. And now what we can see is normalization. I think it's the best way to describe this. We are seeing normalization. So over the past year, since last summer of 2023, you can see that we are now back to adding roughly between 100,000 to 200,000 jobs on a monthly basis, right? Now, in the last few months, some data points have been slightly weak because of the hurricanes or whatnot. But all in all, guys, I would say that we are now normalized back to what we had. Has it been a drop off since the peaks over here? Yes, but keep in mind, these peaks are normalizations from the pandemic era. Now we are currently sitting at a relatively okay level, considering the fact that in all reality, inflation is high, interest rates are high, and companies are doing a lot of cost-cutting measures. Companies are a lot more lean and efficient since the bear market in assets that we had in 2022. So although there's a lot of jobs in the marketplace right now, although we are still hiring, we can say that the trend is a little bit softer than we have anticipated. But once again, is there a major red flag at play here? Are we hemorrhaging jobs? And I think the answer overall, guys, is no, to be quite frank with you, right? And when we measure in terms of, is the Fed too late? Is the damage done? Is the data fake? Well, we can measure, what does the Fed think about all of these things, right? If you take a look at the Fed right here, here are your smooth recession probabilities from the Federal Reserve. And as you can see right now, there's only a 1%, not even 1% probability here, guys, of the economy possibly diving into a recession. Usually when it becomes more and more clear, you can see this number uptick in a very violent fashion. But so far, that has not been the case and has not been the case since the later part of 2021 and 2022. So the Fed is fairly confident, but you may argue that the Fed is biased. So let's have a look at what other analysts are saying about this, right? So let's take a look at Goldman Sachs. Goldman Sachs research reduced its recession probability back to 15%. You can see that Goldman Sachs in early and mid 2023, they had a 35% peak recession case scenario, and the Bloomberg consensus, measuring a number of different analysts from different institutions, they were already up at about 65%. So the risk of a recession was a lot more pronounced in 2023 than we are right now. The Bloomberg consensus is now down to 30%, which is still on an absolute term fairly high, right? It's not 10%, it's not 5%. So they do believe in a 30% recession odds. Goldman Sachs tapering back their expectations to around 15%. So if you do not believe the Fed, at least you can derive that the trend in terms of overall recession probabilities has been swinging lower and lower and lower as the jobs numbers come in fine, as inflation continues on its downtrend, although being on a bumpy downtrend, and as economic data, especially measured by GDP, is not as bad as people have been anticipating. So those are both data points from the Fed and from different analysts in terms of, is the data fake and is the Fed too late, and will these contribute to a recession? Well, we see the Fed's probabilities for a recession, and now we also have the probabilities from analysts. So that's 3 points already covered. Now, number 4 is the Trump factor, right? Will he possibly lead to more tariffs, which could lead to more inflation, and also possibly mismanage the economy with some form of very, let's call it, brutal policies when he takes office? We know that he's going to be all about government efficiency. He created a new department for that, and Elon Musk and Vivek also will be part of that department and are seeking to cut government spending by a very, very large fashion. So a lot of these policies will be, quite fast pace when Trump takes office. And we also know that he will be starting tariffs. He's also come out recently and put 25% tariffs on Canada for us to lock down our borders and prevent the funneling of drugs from the Canadian border through to the US border, but also to stop the funneling of illegal immigration from Canada to the US. He has done the exact same thing to Mexico as well recently, 25% broad-based tariffs, and said if you guys do not control your border in terms of the flow of drugs, in terms of the flow of migrants as well, those tariffs will stay in place. Now, so far in terms of the tariffs against the European Union, those remain somewhat unclear, no distinct changes there. However, the ones against China, he is considering a 10% increased, broad-based increase of tariffs towards China of 10% in the most recent weeks, and that is due to the inflows of fentanyl from China into the United States for drugs as well, right? So that being said, tariffs are still somewhat of a toss-up right now, but we know that this is a big negotiation tactic from the Trump administration. 20% tariffs on everybody is probably a little bit of a long shot. It will be conditional, right? So it's a bargaining tactic by the Trump administration, whether or not it ends up being 20 and how that affects. Usually tariffs can lead to inflation because foreign goods are higher priced in the US at that point in time, so people pay more for the same goods, and that could translate into an increase in inflation. But so far, the data on that is somewhat unclear because we do not have Trump's final policies. And keep in mind, these inflation effects from tariffs, they do take several months, guys, to apply. So if Trump takes office in January and applies these tariffs in January, February, and March, they can take a long time to trickle into longer dated inflation characteristics for the near-term future. So keep that in mind. This will only probably play into consideration in the mid to late 2025 cycle. So that is the whole Trump narrative as a whole right now. This one, though, still remaining slightly unclear. Now, the next point here, the market is overvalued. And this has been one that I've seen a lot, right? So this was the CPI. We tackled the CPI one. In terms of, is the market overvalued? A lot of people like to talk about the SPY PE ratio in relation to the historical averages, which is very logical. So let's take a look right here. Here is your S&P 500 PE ratio at a 90-year historical average. So as we can see right here, we are currently standing at a trailing 12-month basis of a 26.57, which is admittedly quite high in relation to most of the historical norms. However, it is nowhere close to being as high as the AI tech bubble that we were having 1999, 2000 into 2001 as well. It is almost on the verge of the 2008 recession as well, but it is still not as high as the roaring bull market that we saw back in 2021 when we had free money. There was a lot of VC activity, venture capitalist activity in the markets, and everything was flying towards record highs, and people were just disregarding fundamental valuations of companies altogether. Now, are we currently relatively high in the S&P? And do we have companies absolutely flying? Yes, but is it 2021? I do not think so just yet. And as a whole, guys, as long as the S&P continues to increase the forward EPS guidance, you will see that this ratio usually sits around a 22 on a forward basis. So once again, are we high in terms of historical averages? Yes, but are we bubble territory high? The data is still somewhat unclear on that. And keep in mind, if AI leads to productivity gains, and if companies are constantly able to increase the overall EPS in their respective sectors, this one should still stay relatively the same, anywhere between a 22 to around a 25. And this report compiled by FactSet points this exact same thing as well. This is dated November 22, just recently of last week, right? So here are your Q3 earnings. What are these companies saying? What is the guidance for next year? We'll take a look, right? For the earnings scorecard right here, we have 95% of companies already reporting. 75% of those companies have reported a positive EPS surprise, and 61% of the companies have reported a positive revenue surprise as well. So as you can see, the trend is still bullish. Companies are still beating on their expectations of EPS. In terms of the earnings guidance as well, right? So in terms of the valuation, rather, the 12-month forward PE for the S&P 500 is 22, which is more in line with the historical average of the S&P, which currently sits at around 18, roughly. The PE ratio is above the 5-year average of 19.6 and above the 10-year average of 18.1. So are we slightly elevated on a forward basis? Yes, but are the valuations getting crazy on a broad market basis? No. Are there certain companies here and there who have ridiculous valuations? Yes, but that is always the case. But can we paint the market with a broad paintbrush stroke and say the entire market is significantly overvalued right now? I do not believe so, guys. The data, once again, is not so clear. So we always have to take this data with a little bit of a grain of salt. And if we take a look down here, guys, in terms of which companies will be outperforming, let me just go to page 25. So if you take a look at the earnings guidance for 2025, you will see that there is a number of different sectors who have raised their guidance by a very wide margin, right? Positive is what we're looking for here for some outperformance in the event of a possible whatever happens to the market next year. If we get more unemployment and the market goes into a recession possibly, these are the industries that may be the best position for that. Talking about industrials, talking about healthcare, which has very high positive EPS, not consumer staples, not consumer discretionary, they are relatively in line. But information technology as well, with all those productivity gains, think of the Mag 7 too. So industrials, healthcare, and once again, information technology, Financials as well, guys. Usually in the face of a recession, you can see slight downturns in financials at a first glance. However, they can be quick to recover, and the EPS guidance is fairly good. So if I had to take some hedges for the market, or what I would be shopping for in the event of declines, I would focus on these sectors who have positive EPS guidance already and still do fairly well in the context of a recessionary environment. So those are just a few key points on those very same factors that we just talked about in terms of the market being overvalued. As you can see, yes, are we higher than historical averages? Indeed. But is it getting ridiculously out of hand? I can't say that I can draw that definitive conclusion as of right yet. Now, moving into the next point, guys, this is a very good one that people like to bring up as well, which is pretty much we have super investors, the likes of Warren Buffett, record levels of cash, and other notable CEOs selling, a lot of insider selling this year, which I've seen a lot on Twitter, a lot on YouTube as well. A lot of people focus on this point right here, Buffett in cash and other notable CEOs selling. Well, let's have a look right here in terms of Berkshire Hathaway's total cash as a percentage of total assets. The dollar figure is staggering, over $300 billion in cash, but you have to measure that cash in relation to Berkshire's total portfolio. Although Warren Buffett is currently sitting with around $320 billion in cash, keep in mind, guys, he is still 76% invested in the market. Has he been trimming some bets on Apple, on companies like Bank of America and other companies alike? Absolutely. But has he also been building new positions? Yes, indeed. Adding a new position, Domino's Pizza, building into positions such as Heiko, building into more positions such as the oil companies as well. So Warren Buffett is a big fan of, yes, raising cash when valuations are not attractive for him, but he's also a big fan of always staying in the market with a large percentage of his portfolio. As of right now, he is still 76% allocated into these markets. And that's a testament to Warren Buffett's strategy over the last 40, 50 years. And I do still share the same opinion. Now, I'm not comparing myself to Warren Buffett, and I would never say that I know as much as him or have near the experience that he has. But if he's done one thing very well, is throughout all the different economic cycles, he does not try to predict the market. He just goes shopping for great companies at great prices. And when he gets those prices, he usually holds them for a very long time. So if we want to imitate Warren Buffett, can we start building a cash pile of 10, 20, 25% of our portfolio? Absolutely. But is selling the entire portfolio right now a good idea? Probably not, guys. It is never a good idea to sell the entire long-term portfolio. You should always stay almost fully allocated to the market because everybody knows the saying, time in the market is obviously better than timing the market as a whole. So you can see that the Warren Buffett portfolio right now, although they do have a decent amount of cash on the balance sheet, a large amount of cash actually, it is not as high as it was early 2000s and even into 2004. Has it been higher than the entire last 15 years? Absolutely, but a lot of people say these are record levels of cash, and they are in an absolute dollar figure amount. However, as a percentage of the portfolio, you can see that we are not near record highs for Berkshire Hathaway. So you have to take that information with a grain of salt. So that's the Buffett effect. Now, other notable CEOs selling as well. We can take a look at insider sales here, guys. And as we can see, Guru Focus is a very, very highly analytical website right here. So as of November 2024, the overall market insider buy-sell ratio is 0.24. That is the same thing as in terms of month over month, indicating they may be neutral about the market in relation to last month. Now, the highest overall market insider buy to sell ratio, obviously the higher the number goes, the more they are buying. That was in March 2020 when the markets were falling apart. And the lowest ratio, synonymous with the topping out of the market, was in February 2021. Now we know the market ran a lot more from February 2021 towards the end of 2021. That was the lowest period. The average ratio is 0.38. So although we are slightly below the average ratio, guys, you can see that when I put this on a chart right here, look at the average buy-sell ratio in terms of down here, right? Well, you can't actually see it because I'm in the way, But you can see, yes, we are towards the lower end, but I wouldn't say that we are towards the absolute bottom, such as we saw early in 2021. So you can see that when we have the 3-month average buy and sell at the lower levels right here, sometimes it indicates that the insiders are, well, they're not buying as much as they were, let's say, over here. But once again, we are not seeing that is falling deep, deep, deep down into the depths of late 2021 when people were offloading and stuff like that, right? So as of right now, I would say that these are still within somewhat of historical average levels in terms of the insider buys and sells. You may see more notable people selling, such as Jeff Bezos and other people like that. But overall, in terms of the degree of insiders selling versus not, I would not say that we are at problematic levels. Yes, we are under the averages right now because the market valuations are high and people are looking to sell their insider shares at these heightened levels right now. But are people just purely offloading everything they have, basically not panic selling, but selling everything because they think that we're possibly going into a disastrous recession? Well, as of right now, the insider buy and sell ratio does not show that that is the case. So this is once again another piece of data, guys. As you can see, when we go through these data points, every single one is not very, very clear cut. Are there certain red flags here and there? Yes, but you can make arguments either way. And until all of these are pretty much undeniable in our face, guys, we cannot say that the probabilities of a recession are greater than not at the current time. So that's it for that point. Then the next one, the US debt ceiling crisis. This is another one that I've seen being brought up for a very long time. So as we know, the US debt levels right now, $35.5 trillion with a big acceleration since 2019 and 2020. You can see the steepening of the curve. As a matter of fact, this started all the way back here, 2006, 2008, when the Fed had to print a bunch of money to get us out of the recession. And ever since then, they've been on this quantitative easing cycle, right? Printing more and more money, buying more and more of their own securities and treasuries. And we have had, as a result, the inflation of the US national debt. Take a look at this. The debt to GDP level has now been over 100% since 2015. So as a whole, the US debt to GDP level is quite problematic right now. Now, there's two ways of thinking about this, right? One is who is actually going to call us out on this debt, right? Well, that's an argument, guys, but it's not a very good argument, right? We need to be able to bring this down because if not, people just lose confidence in our bond market and will not buy our bonds, even though they are currently sitting for a 20-year bond at around 4.5%, which is an attractive yield to lock in for 20 years. That being said, we absolutely need to bring this down, and this has been a hot topic of discussion ever since we've been going through this election cycle. Now, obviously, with the new Trump presidency coming in line, he has been wanting to address this point in a very rapid fashion, wanting to expand exports of energy, which could be a very big contributor to bringing the U.S. debt levels down. Putting tariffs on other companies as well will be a good way of Trump being able to possibly bring in more money and rein in on the U.S. debt crisis. We obviously know that he's entoured himself with his entourage right now in terms of the people that he's putting in respective positions, whether it's the new U.S. Treasury Secretary that we covered last week, whether it's the new Department of Government Efficiency led by Elon and Vivek. Well, though all those things combined lead to us believing that Trump does have a clear-cut focus on wanting to reduce government spending and get the debt levels down. So at least we do not have an incoming administration that is not unaware that the debt level is a problem and they do want to address it. So we know it's a problem right now, but we know that there's an administration coming in that is going to put a big focus on bringing these debt levels down as a whole. So obviously I'm as curious as you guys as to see how he's going to attack this, how the administration is going to deal with this. But at least we seem to be on the right path in terms of them acknowledging that there is a problem and wanting to rein in on excessive government spending and get those debt levels down. So although we are currently right now at, arguably, yes, a crisis level, at least the incoming administration has put forth solutions to try and deal with that. So that's that point right there. Now, the next point is also a big talking point that I hear a lot, guys. I hear this so many times, is The consumer is over leveraged on credit. And as a matter of fact, the US Congress just grilled Visa and MasterCard 2 short weeks ago about the consumer taking on more and more credit. As you can see right here, here's the United States debt balance in terms of credit cards outstanding. And as we can see is that it is at a staggering 1.16 trillion. You can see that in terms of normalization, we had those balances come down after COVID because you got a lot of stimulus money, rates went to zero. People, yes, were borrowing money, but they were paying down their credit cards a lot. So that is the decline right here. But ever since then, since people have been getting squeezed by inflation and whatnot, we have seen these credit card balance continue to rise. However, this leads us to ask ourselves the following questions, right? Is this a product of the same amount of customers just putting more and more on their cards, or potentially since the digital revolution that happened in 2020 with the work from home, people being more interested in the stock market, people being more diligent about their spending practices and wanting to utilize credit cards in terms of replacing cash, replacing debit cards to get those juicy points that these credit cards offer, right? So is that what's happening right now? Or is it the same amount of people that have the same amount of credit cards as back here who are just putting more and more on the balances, right? Well, the answer is very, very complex, guys. We have had a lot more new customers in the credit card industry as a whole. So although this balance number has increased, it's very tough to determine whether or not this has been because there are just more people that are using credit cards right now, or is it the same amount of people that are spending more on those credit cards and keeping higher balances? So we have to dive into the data. The data, you cannot just look at this chart and say, oh, consumers are tapped right now and everybody's over leveraged on credit. As a matter of fact, it is not so simple, right? We know that the total US debt balance from consumers, both household debt and credit, has been on the uptick as well. Here's the total chart in terms of non-housing debt and housing debt. As you guys know, their mortgages are the highest amounts of debt that they have, but the debt levels have been increasing ever since 2012. And although we have seen an acceleration of the curve here, 2020 and 2021, we are now back to a more normalized curve ever since 2023. So the data is once again not so clear cut, right? If we take a look here at American Express earnings, here's the American Express earnings that we just had last quarter, right? Here's the total provision for credit card losses by American Express. So it stands to argue, if the credit card issuers were to think that this number right here was a problem, well, they would have to protect themselves. And how do they protect themselves? They put away more and more money for credit card losses. Now, we do know in terms of worldwide total loans and card member receivables, these numbers have been going up. However, that is because these companies have more and more and more clients. They continuously grow their client base, which is why these loan provisions and card member receivables go up. But in terms of each member, right? Now, each member, is it a problem? Well, American Express gives us that data. 30 plus days past due. Are people past due and defaulting on their loans? Here's the pre-pandemic ratio at 1.5. And I've been covering American Express earnings, guys, for the last 6, 7, 8 quarters on the channel publicly. And over the last 8, 9, 10 quarters, these numbers have all been below pre-pandemic levels. So are consumers tapped right now and putting more and more money on their credit cards to where they cannot pay and they're defaulting on their loans? Apparently not. We are now under the pre-pandemic levels. Very curious, isn't it? Net write-off rates. So when people cannot pay anymore and they just write off the debt, so they say, sorry, I can't pay, you guys are going to have to deal with it. Pre-pandemic, 2.2% of their clients. Since the pandemic, they have been under the historical norms. So as we can see, guys, this chart right here does not paint the full picture. And if you were to go through, I'll just show you American Express, but if you were to go through the MasterCard and Visa earnings cycles as well, you will also see that they are not putting on an astronomical amount, this chart right here, they're not putting on an astronomical amount more of total loss provisions, nor are the big banks. We covered big bank earnings about a month ago on the channel. JP Morgan, Wells Fargo, Bank of America, Citigroup, just to name a few. The banks are well capitalized and they are not increasing their loan provisions more than the amount of new customers that they have. You would need to see an exponential increase in loan loss provisions if the banks thought that there was any worry of a credit cycle crunch, which is not the case right now. We see it in the credit cards, we see it in the big banks as well. So that is just that. And I will leave you with this quote from MasterCard earnings, as a matter of fact, for their most recent Q3 cycle. The macroeconomic environment remained supportive and continues to underpin the strength in consumer spending. The labor market remains strong, even if slightly below historically tight levels, and inflation has moderated, albeit at varied levels across categories and countries. Overall, we remain positive about our growth outlook, but we will continue to monitor the environment. They are literally saying the exact same thing I've been saying on the channel as well. We've went through all these company earnings. We went through the bank earnings, the credit card earnings as well. Loan loss provisions are not expanding at an exponential rate. And as we saw with most recently with American Express, but you guys can go through Visa and MasterCard as well, the amount of people either 30 days past due or the amount of people defaulting on obligations is not even at pre-pandemic levels yet. So we cannot paint this sector with a broad brush and say that this chart right here is problematic. If anything, I do firmly believe that it's just a fact that more and more people prior to the pandemic were not using credit. Since the pandemic, more and more people have pivoted from cash and debit cards to using credit, which is why MasterCard, Visa, and American Express have increased their customer bases in that same time period, right? It's all in the data. And when you have to look at this data, you have to look at what the banks are saying, what the credit cards are saying, because this chart does not paint the full picture. So hopefully, guys, that makes sense for you. And in terms of the banks, we're not going to go through each one. We went through that about a month ago, but I will remind you, the banks are excessively well capitalized right now. CET1 ratios right now for JP Morgan, 15%, which is very solid. The SLR, the liquidity ratios, above the required minimums at 6%. The minimum is 5%. And the LCR as well, guys, above the 100% minimum. These are just capitalization ratios. Does the bank have enough money in the event there is a credit cycle crunch because the consumer loses their jobs and has to default on their loans, right? Is the bank well capitalized to absorb that shock? And as a matter of fact, when you look through these liquidity ratios at all these banks, because of the Basel III requirements that were put forth after the disaster that was 2008, the financial crisis, the banks right now are too well capitalized, guys, to go through a credit cycle crunch and have a crisis and have to shut their doors. I'm essentially saying that as of right now, because of the capital ratios and the liquidity ratios of the banks, they are too well capitalized for us to get a 2008 credit default scenario where the entire financial system is on the brink of collapse. It's just not going to happen. These are the numbers from JP Morgan, but feel free to go back to my prior videos from about a month ago when I covered the bank earnings, or go through them yourselves and you will see the banks are well capitalized and above their minimums. So that is everything that I had to say in terms of the in terms of this point right here, which is a very big one, right? Consumer being over leveraged on credit. You have to look at all of the data points. Now, in terms of the next one as well, guys, commercial real estate crisis and the bond unrealized losses at the banks. Now, this was a scare that we had in 2023. I'll remind you, you guys remember March of 2023, there was a big deal and a few small, medium, and regional banks actually went underwater. A few of them had to be assimilated into names such as JP Morgan, right? JP Morgan acquired them. You can think of names like Silicon Valley Bank. Big crash on that over there. And now you can see, guys, these banks have largely recovered all of the losses so far. So I want to touch upon this point very briefly, because I do not think that it's that big of a deal. We covered this as well when we went through the bank earnings about a month ago. All these banks were asked by analysts, how are your commercial real estate portfolios doing? And the banks were saying, yes, we do have a certain few clients that are underwater on their loans right now, but we are well enough capitalized to be able to absorb those loans and then wholesale the loans to the highest bidders thereafter. So the banks, in other words, are not going to be left holding the bag. If anything, can you see certain problems arise in these small and medium regional banks? Absolutely, that's always the case. I'll remind you, in the United States, there's over 5,800 different financial institutions. It is a very large market. but the ones that you have to pay special attention to are the largest of the bunch, the large cap banks. Talking about JP Morgan, Bank of America, Wells Fargo, Citigroup, just to name a few. And all of those banks are well capitalized, and the percentage of exposure to commercial real estate is quite small in context of the overall loans that the banks have outstanding. So I would not say that the commercial real estate crisis is materializing as of right now, but we are in a rate cutting cycle, so the rate cutting cycle obviously goes to alleviate some of the pain that's there right now, but it won't do it all right away. And the other one are bond unrealized losses at the banks. Last March, the banks were criticized for their accounting practices in terms of unrealized losses. People were saying that their balance sheets would not be as solid if they were to account for the unrealized losses that they have in the bonds. Obviously, these banks took on a bunch of bond exposure back in late 2020 and early 2021 when essentially when rates were extremely low, right? Obviously it stands to argue that when you're buying bonds, right? When you're buying bonds, all the way up here when TLT is at record levels of highs because interest rates are at 0, and you buy bonds up here, and then what happens? Rates go to 5%. Look what happens to your bond portfolio, right? So investors were locking in yields of between 0.5% to 1% on 5-10-year bonds and even longer duration bonds as well. You can just go on the yields, right? Just go look, how much were they locking them in for? All the way back here in 2021. And you will see, guys, the 20-year yield was only 1.3%. Now it's all the way up. It is now almost 4x from those levels. So everybody that bought bonds, especially institutions that bought bonds all the way up here, well, now they're severely underwater, which leads to these unrealized losses. However, notice the term, guys, unrealized losses. These banks are locked into those bonds for the next 5, 10, 15, 20 years. They are not trading them as equities. They are not going to close them at losses. That is all they are. They are unrealized losses. Are the banks still collecting a coupon payment once every 2 years? 1%, 2%? Absolutely. And that is why they buy those products, because they're said to be risk-free assets. All of them, or most of them, are treasury bills from the Federal Reserve. So unless you believe in the default of the US government as a whole, these banks are not going to realize any of these losses. They will collect their semi-annual coupon payment, 0.5%, semi-annually, 0.75, 1%, depending on the duration of those bonds. And that is just going to be it. It's the same thing as if you buy a bond right now for the next 10 years. You will receive a semi-annual coupon payment, and that is what you get. And you get back your par value of that bond. If you invest $1,000 into it now, you'll get 4.5% annualized basis for the next 10 years, right? You'll get it once, 2 times per year, and that'll be your interest payment. And then you get your $1,000 back at the end of the term. That is how these banks are playing with these securities. So there really isn't a need for them to encompass for those unrealized losses. As a matter of fact, they touched upon these in the most recent quarterly earnings cycle, and they also voiced that very same opinion that it's not a problem for them. These are longer duration assets that they are holding on to and just collecting some very juicy interest income on those bonds. Now, the next point is a very decent one as well. The rest of the world is in a recession, and this is true. If you look at several nations in Europe, they have been struggling since the pandemic. As a matter of fact, they really have not recovered that much since the pandemic. You need to look no further than companies such as Spain, companies such as Portugal, countries such as Spain, Portugal, Greece, Italy. A lot of them are underperforming right now, and also very large nations such as China. China has also been in somewhat of a recession for the last 3 years. So China and Europe have all been in recessions. But what people do not talk about is you also have several other nations that are doing very well. Nations such as South Korea, Taiwan, places like Singapore, places like United Arab Emirates. A lot of different places in Europe, such as the northern Nordic countries in Europe, are doing quite well. Germany is a little bit iffy right now, but we do have some outperformance in a lot of different European countries. We also have significant outperformance in Latin America. Latin America is growing very nicely. So although people like to focus on the few bad apples across the world right now, I cannot paint this with a broad brush stroke and say that the entire world is entering into a deep form recession right now. I would say that the data is relatively mixed. However, the US has been synonymous with outperformance, especially in the last 2-3 years. This is probably the strongest economy in terms of the world right now and does maintain that status. So the rest of the world being in a recession, as I say once again, guys, it depends which countries you look at, but we cannot paint it with a broad stroke and say that the entire world is in a recession. There are a few bad apples here and there. For the most part, though, analysts and economists are expecting China's recovery to happen late stage 2025, and a lot of European countries as well, their recovery is slated to be towards the end of 2025, as they are now reducing interest rates as a whole. The ECB is reducing interest rates, and that should go to help to kind of stimulate these economies who truly have not made it out of the recessionary cycle that they've been in, balancing the labor market, balancing inflation since the after effects of the pandemic. The US has really been outperforming everybody in that respect, which is why I choose to invest in United States companies as a whole. But also there is some outperformance, guys, depending where you're looking at. A lot of Japanese stocks have performed very well. A lot of Latin American stocks have also performed very well. Names such as Mercado Libre, names such as New Holdings and you can find outperformance in some emerging market trades. So just keep those in mind. Now, the next one, of course, is a very important one. The AI and tech bubble. This is a very, very hot topic right now. And I also do believe that it is fairly unclear. Yes, companies have spent a lot of money building out infrastructure over the last 2 years. We've had the data center ramps and whatnot. And as of right now, the productivity gains for those same companies are not so clear. As of right now, we only really have large language models, but the advancements in robotics and the advancements in medicine are not yet that pronounced. However, we have to view this in terms of a longer duration. Yes, the companies are spending money now, but 2026, 27, and 2028 should be seeing very good productivity gains from those heavy investments right now. We've heard from Amazon, from Microsoft, from Meta, from companies like Google as well, that they do anticipate to see those big productivity gains and reductions in costs and more cost efficiency come in about the next 1.5 to 2 year time period. So are we in a AI and tech bubble? Well, you guys know I cover a lot of stocks. I mean, you can argue that maybe Palantir is a little bit expensive right now, but we go through the valuations of big tech a lot on the channel. As a matter of fact, we go through them every single day. Yes, certain companies are more expensive than others. Apple right now has a PEG ratio of about 3.19. That's expensive. A company like Amazon, however, PEG ratio only a 1.48, relatively cheap right now. A company like Google, PEG ratio of only 1.21. They are growing earnings very, very quickly. Unless you start seeing all these companies trade at over 3 pegs, you know that the Mag 7 is not that expensive. Meta PEG ratio, 1.78. Anything above 2 starts to get rich. Between 1 and 2 is fine. Company like Microsoft usually trades a little bit more rich than the competition because the business model is so consistent and predictable. Their PEG is above 2.17. However, you would be hard pressed to ever find Microsoft, except for in a big asset market crash like this, you'd be hard pressed to ever find Microsoft under a 2 peg. They're just too consistent. A company like Netflix as well. They are now at 715. We measured this. Now they're about, arguably 20% higher. So this PEG ratio should still be under 2. So as of right now, even Netflix towards the all-time highs. Are they slightly expensive? Yes, but ridiculously expensive? No. And a company like NVIDIA as well. Their PEG ratio after earnings, when we did it, the PEG ratio is sitting at about a 1.94, growing revenue and EPS very nicely. So we can go through a lot of other companies individually, but when you look at the largest players in the game, the ones that have the most weight, that can move the market the most, right, stands to argue if people are really concerned about valuations, they would be flushing these, not wanting to be part of that trade anymore. But as we saw, guys, the valuations are decent. I'm not saying they are cheap, but are they a little bit rich? Yeah, sure, a little bit rich. But are they ridiculous right now? I cannot derive that they're ridiculous right now. So are we potentially at the start of an AI bubble? Yes, but keep in mind, guys, these things don't have to necessarily exponentially move higher when you come into bubble territory. You can just grind higher for maybe the next 6 to 12 months before valuations actually get unanimously consent basis, unanimously overvalued, right? So as of right now, can we find certain companies here and there that trading a lot more expensive than they should be? Yes, but are the biggest players currently trading overly expensive? I wouldn't say so, guys. That is, once again, is debatable, right? Now, the next one, the yield curve being uninverted. Yield curve uninversion triggers a recession every time. This is a classic one. It happens every single time, guys, to where people constantly bring this one up, right? So let us have a look, guys, in terms of whether or not that's the case, right? Let me just close out a few tabs right here that we're not using anymore. So in terms of the 2 and 10 year, a lot of people like to say, well, the yield curve is uninverting, must be synonymous with a recession. As you can see, they are referencing the past 3 times this has happened. You can go all the way back to 1989 as well. Federal Reserve, right, cutting interest rates, stands to argue that when the Fed cuts interest rates really quickly, the 2-year yield, well, trends towards the Fed, where the Fed is cutting to. If they go from 4% down to 2% super fast, the 10-year is going, or the 2-year is going to plummet from 4 all the way to like 2.25, 2.5. But the 10-year, because people are flocking to safety, flocking to longer-term bonds, people are flocking towards those. So will the 10-year also drop? Yes, but it'll drop less aggressively. That is why you get the uninversion of the yield curve, right? Where the 10-year now is a more valuable, gives more yield than the 2-year. And every time they've done this, the last 3 times, as you can see, when the yield curve uninverts rather, it tends to lead to a recessionary period, which are these bars in gray. 1989 into 1990, 2000 into 2001, of course, and of course the great financial crisis of 2008, 2007, all the way into early 2009. The past couple times have triggered a recession. And what do we have right now? Well, we have, once again, the uninversion of the 2 and 10-year yield. However, once again, you have to, no recession is the same. You have to study why is the Federal Reserve cutting interest rates right now and why are yields uninverting. So I will bring you to this following chart right here. The recession factor, this is compiled by routers, right? So as you can see, it says a cut and then what? Because it asks this question, whenever the Fed cuts interest rates, why does it usually trigger, a recession, right? Is it the chicken or the egg? Is the fact that the Fed cuts interest rates, is that what triggers a recession? Or is the economy already bad enough that the Fed has to cut recessions, right? For recessions. And the last 3 times, it has been a fact of the economy is not doing so well, so the Federal Reserve has to react and cut interest rates at a fast pace. So in this case, it is definitely the chicken that predates the egg necessarily, right? We can go a little bit further and see, we have to study why is the Federal Reserve cutting interest rates? There's 2 different scenarios in which the Federal Reserve is going to cut. One of them is what they've been doing right now, normalization. The economy is doing well, but to prevent the economy going into a recession, you start cutting interest rates to prevent the jobs market, falling apart and to prevent economic activity from falling apart as well. So normalization, 1989, 1995, and 2019, when the Fed just cut interest rates to accommodate an economy that was already doing well to prevent keeping rates too high for too long and crushing economic activity. As you can see, 3 months after the first cut, 6 months and 12 months, all has positive returns. And right now we are in a normalization rate cutting cycle. Now, when we are in a bad state in the economy and the Fed has to either panic or because the economy is displaying recessionary characteristics, that is when in the first month and even the first 3 months, that becomes a clear defined case where when the Fed does cut aggressively at that point, that is when you see the market plummet. But the market does not plummet because the Fed is cutting interest rates. The market plummets because the economy is already heading into a recession and the Fed is reacting to that data, right? But as we can see, and if they panic, right? So right now we are in the normalization rate cutting phase. But if the data erodes over the next 3 to 6 months and the Fed is forced to panic to avoid a recession, then the first month and 3 months will be somewhat unclear. But if they panic and cut rates to 1% really quickly to avoid the doomsday recession scenario and loss of massive jobs and whatnot, well, then this is the buy trigger, because we know that 6 to 12 months after a Fed panic usually is always a very good time to be buying when the Fed is panicking because you are heavily rewarded thereafter. So as we can see this point as well, right? The yield curve point, not so clear. It all depends whether your opinion is, are they cutting because they are normalizing, which is what they're saying they're doing right now, or do you think they're cutting because they're panicking and they're late, right? Both of which have different outcomes. So once again, guys, not so clear on this bear market thesis point either. Now, the next point is the Sahm rule, which is a 0.5% increase in unemployment in 3 months from the lows. The chart, which I've since erased, unfortunately, guys, I kind of closed the chart. I want to bring up Claudia Sahm herself because this is one that everybody talks about, the Sahm rule, the Sahm rule, the Sahm rule. Well, you may as well hear from Claudia yourself, right? And as you will hear from Claudia, she as well says that this time is different. The factors have been heavily impacted from an unexpected scenario, which was COVID, the impacts from COVID on the labor market, on inflation, and now the normalization of the labor market after COVID. Take a look. This will be about 2.5 minutes, 3 minutes, but I want you guys to listen to Claudia Sahm herself to describe how the rule may not paint the full picture this time around. So let's get into it.
That the simple rule that I had, the Sahm rule, was too simple for this very complicated set of events that came along. And so, in fact, starting in about 2022, when recession discussions heated up in the US, like we've kind of been in this rolling recession watch for multiple years now, I had written about why the Sahm rule could fail this time. And in fact, I was in Bloomberg last fall when the unemployment rate was rising, and I had a piece, and it's like, this time may be different. It may fail. And I got some pushback from people. Why are you undercutting your rule before you have to? And I'm like, because it has a flaw that it's really clear we are headed at. And so what the 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 because the Sahm rule looks at changes in the unemployment rate. Typically in recessions, changes come about from there's less demand for workers, right? So you're not hiring, there's layoffs, things that cause the unemployment rate to creep up. And it has historically been the case that once you get an increase of a 0.5% point or more, so that's the Sahm rule threshold, then it keeps going. Right. And so in the mildest of recessions that we'd seen previously, so in 2001, the unemployment rate had risen 2 percentage points. And typically it's more like 4 percentage points. So the idea of Sahm rule is to kind of catch it early. And then, before things have really kind of spiraled up and the unemployment rate is much, much higher. Now, the other reason that the unemployment rate can increase is if we have an increase in the supply of workers. And that's very different in terms of its future prognosis. Like in the present, that still is workers looking for jobs that don't have jobs, right? So in that moment, that is not good for those workers, and that's a problem. And it's people that aren't out there working who want to be, right? So it pushes up the unemployment rate. But what it tells us about the future is the exact opposite of this lack of demand for workers. It's telling us once we get these workers jobs, we can grow. We can grow even more than we were on the path before. So it has a very good news dynamic at the end, uh, which is not recessionary. And what's happened is in the U.S. we've seen some really big swings in the we've seen some very big swings in the labor force. So early on, we had millions of people drop out because of the pandemic. Then we had labor shortages. The American consumer came back faster than some of the workers who had dropped out early on in the pandemic, and we had labor shortages that pushes down the unemployment rate, probably artificially so, relative to a world where we hadn't had a pandemic, have workers drop out. And then in recent years, we have solved that labor shortage largely by more workers, not fewer customers, which is a huge win. And that probably is a big reason why we haven't had a recession in the last 2 years, and yet we had inflation come down, and yet that increase in the labor force, and some of it, we had a pretty abrupt and large increase in immigration. Some of those workers coming in, it's now taking them a little longer to find jobs, and so that is pushing up the unemployment rate. So the Sahm rule, there is a weakening of demand. Right, the U.S. labor market is not firing on all cylinders like it was, a few years ago, and yet the Sahm rule looks more ominous because a piece of that increase in the unemployment rate is this labor supply side, which is.
So there you have it from Claudia Sahm herself, guys, right? So as you saw, not so clear cut the balance between new supply of labor and the demand side from consumers. There's a lot of different things at play. And as you saw, she said at the end, the Sahm rule looks more ominous right now than it possibly actually may be. So from herself, guys, once again, going against her own rule, and she has been criticized for this over the last 2 months, ever since that she's been saying that this time may be different just because of the sheer impact that the COVID cycle has had on the labor force, on the economy, and now we just might be seeing a normalization of things, right? So very complex topic. Take it from Claudia Sahm herself. Even she is not saying that every single time it happens, it definitely triggers. The times in the past that it has happened, it has triggered, but take it from her herself. She's explaining why this time may just be different because we had a one-time event, the pandemic, which has never been seen before in the history since this rule has been applied. Now, the next point, guys, is manufacturing output has been relatively weak. Now, the ISM Manufacturing Index, guys, admittedly, every time this comes up, and this is what led indirectly to the short-form sell-off that we had. This was the short-form sell-off that we had in the month of August, right? You guys remember the August period where we had that very, very, very rapid decline in the markets all the way back over here. Now, what happened over the course of this week was exactly that. Thursday, this big red candle day right there, this was the first indication of very soft manufacturing, followed up by the non-farm payrolls report that was a lot softer than expected. It led to the Black Monday event and the Japanese carry trade unwinding. That being said, guys, manufacturing data has not that much improved ever since that time in August, but we can see that we are at lows that we have seen in prior cycles as well. We saw these lower levels for about 6 months worth of time in 2016, in 2012 as well, and of course, even prior to the pandemic, late November. So, are there maybe some seasonal factors at play right here? Yes, but as well, in terms of manufacturing output and demand, do not forget that a big catalyst of this heightened manufacturing capacity was the building out of supply chains after supply chains got absolutely destroyed in 2022. Companies did a very good job in terms of building a ton of new factories, building new logistics, new transportation hubs, and now the demand has been slightly weakened. Well, these companies cannot fully produce at optimal levels at all these extra built out factories that they built because the supply chains were broken. Now that we have normalized, there is now an underutilization of those new manufacturing facilities. So yes, half of the manufacturing output, the weakened output by manufacturers and the weakened new orders is a byproduct of the consumer being more picky with their spending. However, another portion of this chart also does show that there was a lot of production capacity built out back here that is not currently being used. So just keep that in mind as well here, guys, in terms of how full the manufacturers are saying that production actually is. So once again, this, yes, is an indication that the economy is slowing down, but is the economy currently falling off a cliff? Once again, that topic is once again debatable, right? Another point that's debatable. So as you can see, guys, it is not black or white. If anything, these entire arguments are somewhat gray right now, but we have to be aware of them so we can constantly monitor the data on a moving forward basis. There is also a factor of anecdotal experience, right? My friends are broke. Yes, maybe your friends are broke, guys, because they're struggling with inflation right now. Maybe they're still paycheck to paycheck, but I will remind you, the average American or the average worldwide citizen is always paycheck to paycheck because of lifestyle inflation as well. They can afford to taper back on their purchases and buy, instead of buying steak, buying hamburger meat. But in all reality, nobody likes doing that. Instead of buying chicken breasts, you buy chicken legs, stuff like that. There's a substitutional effect here. But for the most part, the anecdotal experience that I have, guys, is yes, are my friends choosing to go out less often to spend $100, $200, $300 at restaurants? Yes, but are they losing their jobs and stopping spending as a whole? No, I wouldn't be able to say that right away. So yes, we have some consumer discretionary weakness right now, but is everybody losing their jobs? And 5 out of 6 people talked to, are they struggling to meet their rent demands or struggling to put food on the table? No, but they just have to be a little bit more selective with their choices. And this will be helped, of course, when we get lower and lower interest rates and whatnot, and the consumers continue regaining purchasing power through the wage increases that have been happening over the past 2-3 years. It is a very slow process, that of regaining purchasing power, of course. And then lastly, we have some indicators. There are a lot of people on YouTube and on Twitter as whatnot, you'll see these charts all the time. Percentage of smart money versus dumb money in the markets, institutional buying versus retail buying, etc. Percentage of stocks above their moving averages, such as percentage of stocks above their 50-day moving averages, as we can see right now. Percentage of stocks above their 50-day EMA, or SMA rather, is 65%. Broad market bullishness, percentage of stocks over their 200-day moving average, once again, 63%. Broad market bullishness, nowhere near the disaster that was last fall in October 2023, nowhere near the depths of the asset bear market that was 2022, and nowhere also near the scare that we had this August and even the scare that we had in April as there was a resurgence of inflation. So the markets right now, fairly broad overall. If we take a look here at the put to call ratio too, put to call ratio does signal the fact that there is far less puts than calls. The ratio is under 1. You know that the markets are a little bit skittish when we are all the way up here above 1. There are more puts. People are more buying insurance right now. And as you can see, right, usually people are late. Every single time the markets are already in declines is when you see this ratio start to uptick, right? So the trick is trying to position prior to the market crashes. So this would be a contrarian indicator. When everybody down, when nobody is buying puts, essentially, that is traditionally when you would want to load up on insurance. But I wouldn't say that you can use this as a either leading or lagging indicator, because as we can see, the market, when the market starts to drop, people are already way too late. This peaks when the market has bottomed. So I would not say that this is a good leading indicator, right? So in terms of indicators and using various charts, you know what I mean? Like Shiller PE ratios and all that. Like I know all of them, guys. The Shiller PE ratio, percentage of stock, smart money versus done money, put versus call ratio, the VIX being at historical lows as well. These are all indications that yes, even with the markets at all-time highs, it's good. It's a good location to be buying the protection because the protection is cheap. But will you need the actual protection? Keep in mind, a lot of people like to run puts on a yearly basis, the similar way that you were to buy home insurance or car insurance. You pay insurance every month, but are you expecting your car to crash every month? Are you expecting your house to burn down every month? No, but it's nice to have in the event that it does happen, right? So that is once again my idea in terms of insurance. Yes, you can buy insurance if you have a heavy penchant to agreeing with all of the bear market and crash and recession thesis points of the market. You know, there are several ways of hedging this. You can go into bonds such as TLT. A lot of other people use gold. Some people use some of the more defensive sectors that I showed down here, such as industrials, such as healthcare, which usually perform well in the context of a recession. Even places like utilities in the context of a decreasing interest rate, which will make these dividend yields on utilities more attractive. These could be decent sectors as well. Financials, when the market comes down, decent sector to position in, and tech, just because a lot of Magnificent Seven names, although they will be affected by a potential recession, they have a lot of cash on the balance sheet. They will be first to recover. Positioning into a recession, usually more defensive, but at the bottom end, when the market has come down, SPY, QQQ down 15, 20, 25, 30%, these guys, information technology and financials, these are the ones that you want to go shopping for first more than anything, right? These right here, plus bonds, that can be some defensive positioning ideas if you think that we are due for a potential big market pullback, and if the indication right now is that the market is getting a little bit too greedy in terms of how bullish we are. So that is a very brief, well, not brief, it's been about an hour right now, but that is my summary of the bear market thesis, the market crash, the market recession thesis. As a whole, I try to stay as objective as possible and just present the data for what it is, and I allow you guys to derive your conclusions. But the one thing that I want you to always be open to is there's always two sides to any argument. We went through all of these various data points, And as you can see, guys, other than really manufacturing being weak, all of these points do have counter arguments that are very, very logical, and which leads us to believe that a recession may just not be on the doorstep right away. Can it possibly happen late 2025 or 2026 or 2027? Yes, possibly. But are we on the verge of a big market crash and a big recession within the next maybe 2 to 3 months? I do not think that the data does support that just yet. In my opinion, we will only get recessionary data if we get 2-3 months in a row of unemployment rate really going up high, non-farm payrolls, manufacturing continuing to decline, consumer sentiment continuing to decline, and the X factor, the nail in the coffin, will be February and March. Why? Because February, we get all of these company earnings and guidance for the year moving forward. And if they look at all the data that they're getting over the course of this Q4 period right now, and if they feel that the economy is getting tighter, the consumer is unwinding, and that possibly we are going to go into a more tight economic environment, what will they start doing? They will guide for lower profits. They will guide for lower EPS on the year, and they will also seek to counterbalance those two things, the loss in EPS and the loss in profit margins. How? By laying off their workforce. So in my opinion, we will get a clarified idea of a recession coming sooner than later in maybe late January to February. At that point, you will have the next 2-3 months through the winter of 2-3 more months of inflation data, of GDP data, of manufacturing output data, of jobs data as well. All of that will lead into the Federal Reserve's decision for the interest rate cuts in December and January, and will also lead to corporate guidance in February. So in my opinion, guys, we won't have a perfect idea of whether or not we're into a recession in the short term, at least until February. So as of now, the way that I'm positioning in the markets, guys, is as I always say on the channel, I'm cautiously optimistic. I'm cognizant of all of these factors right here. It's just that right now, my positioning in terms of bullishness versus bearishness, I'm about 75% bullish towards bearish, right? As a whole. So take from that what you will. In terms of my positioning, right? I'm cautiously optimistic. Yes, I am net long in my portfolio, but I'm not getting too greedy. For any trades, I'm closing the trades with decent profits. I'm not getting too greedy and holding them for too long. And I'm also running my classic wheel strategy whereby we write puts on companies below current market levels, and I'm not looking to chase. So my trading style right now is not maximum greed, maximum FOMO. I'm still identifying quality companies at good valuations that are relatively low compared to the high flyers that we've had over the last few weeks. Which leads me into my very last point, guys, which is the market psychology of a top. It comes into game theory and the unexpected move of the market. So it stands to argue, guys, this is a whole lot of game theory and market psychology. And this is the last point that I'm leaving you on, and the point that I raised last Friday, right? In YouTube comment sections, on Twitter, in traditional financial media right now. Everybody keeps talking about these points, and they have been talking about these points, as Miss Claudia Sahm has been saying as well. They have been talking about these points for the last 2 years. Now, in the last 3-4 months, there's been more and more discussion of this. Why? Well, because the markets keep clipping new all-time highs, and people don't seem to understand why. The SPY keeps clipping new all-time highs. Why the QQQs keep clipping new all-time highs. Why indexes such as the Russell are showing greed right now, people bidding small caps. Why are people bidding small caps if there are fears of a recession right now? And more than everything, why are people bidding Bitcoin and crypto, a pure risk-on asset, when we have recession concerns? Do they not understand all the points that we have previously raised, right? Well, I will remind you guys, go back to the mother. So this is why I've coined the term. This rally right here has been the most hated rally almost of all time, behind or maybe even over late 2020 and early 2021, because of the after effects of the pandemic everybody was calling for a recession. Unemployment was crazy, supply chains were broken, inflation on the horizon was a very real thing, and nobody cared. People kept bidding and bidding and bidding and bidding. You had the GameStops, you had crypto going crazy, the small caps were going crazy, big tech names were going at crazy valuations, IPOs all over the place, SPACs all over the place, and everybody was making a ton of money, and it left the haters and people who are logical in pure disbelief. And this time has been the exact same, arguably. It started with the AI rally, people not believing in AI. Then the gains really started to ramp up, and it all started this March and April, where on my timeline, I started seeing more and more people hate the rally because they missed the NVIDIA rally. And as of right now, they missed the Palantir rally. They missed the small cap rally. They missed the crypto rally. And now it leads them to believe that everything is overvalued and overbought, even though we are not truly that much further, right? On a lot of these indexes, right? I will remind you, we are not so much further extended than the highs of 2021. Look at the Russell. The Russell is barely up in relation to 2021. Bitcoin is well above its cycle highs right now. But then again, in terms of the overall expansion, yeah, we're close to 100K, but how much further are we than the 21 highs? About 40%, right? Look how much we actually got from this cycle high 2017. We came all the way up 200+%, right? So as of right now, I would not say that we are crazy levels on Bitcoin. The dollar figure may make you think twice about it, right? But not at really crazy levels. IWM as well, not crazy levels. And depending on the stocks that you look at, right? Companies that were ultra popular back in 2021, companies like Etsy. Take a look at Etsy's chart right now. You'll see nowhere even close to 2021. So as of right now, it has not been the everything rally. You can pick and choose which sectors have rallied, which ones have not. But a company that invests in innovation, when you're going to see a market top, guys, is when companies like ARKK really start flying. As of right now, they have not been flying. We have not seen a resurgence into small cap, into AI. So if you guys are sick of the AI trade right now, just wait for what might possibly be on the horizon, which leads me into the psychology of the market and the game theory, guys. There are still too many people in the market that are either bearish or expecting a crash, and they have been since 2022. And I'm here to say, guys, it's all about game theory and it's all about the unexpected move. The reason that the market is not crashing, guys, is because there is still too many people that expect the market to crash. That is the simple fact of the matter right now. Until most of everybody that is tired of seeing people make money buying Palantir at $45 and now it's at 65, and apparently, you know, according to other people's opinions, right? You might see somebody enter the market for the very first time this year. They watch a few videos on YouTube. They buy Palantir at $45 because some influencer said it's the stock of the future. They went all in with $100,000 into Palantir at 45, and now it's up to 65. They're up 45%. They are in one stock and they may have beaten your entire returns for the entire year, and it pisses you off, right? Some other people, young people, have 20,000, 30,000 to their name. They plowed it into Bitcoin at 60K. They are now up 50% on their holdings, and you are in absolute disbelief. How can people who are newly entering to the markets make so much money in such a short amount of time? And you've been studying the markets. You practice fundamental valuation concepts. You're very patient. And now all these people are making more money than you. You've been predicting a market crash. You've been predicting sideways markets or a big correction, and it's just not happening. You may be even short or in cash right now, and you're missing out on gains. The SPY up 25% this year. The Q's up 25% this year. And you are now frustrated, which every single day now, you may be wondering, what if I'm wrong? What if the bulls are right? What if I now have to actually pivot all my cash, close my put options, close my shorts, and go long? Well, I'm here to tell you guys, until most people pivot from cash to long, from shorts to long, from bearish to bullish, you will not have the market crash that you are looking for. It is game theory. The market always does what it is unexpected from it right now. And until I start to see signs that the market is topped, I am also still going to be cautiously optimistic. Have there been a few people that I haven't seen in 2-3 years now start to ask me about stocks? now start to ask me about crypto? Yes, but nowhere near the levels that I was getting in late 2021. So there is still a long road, guys, before we can. What I'm here to say, guys, is do not be surprised. I'm not saying it's going to happen, but do not be surprised if the markets can keep ripping and ripping and ripping into 2025, and it's just going to leave you frustrated on the sidelines. The market can stay irrational longer than you can stay solvent, especially if you have heavy short positions right now. I am not in the business of predicting market tops or market bottoms. I will follow the data and follow the market narrative and the sentiment right now. And in the echo chamber, if you're in the echo chamber of stocks every single day, you may think that it's getting overly bullish. But until people that are not in the market start asking you about the market, that is your top signal, guys. Until your grandmother is asking you how to buy Bitcoin, we have not reached the market tops that we have in 2021. Is it getting a little bit extended right now? Sure, but nowhere close to full risk on mode in the markets right now. There's still way too much money on the sidelines. There's still way too many people that are pessimistic, and this ties into game theory. They want to trap each and every last person in the markets before potentially unraveling for a deeper correction. And as of right now, they will say that the data is good enough to warrant more gains on the S&P, and the earnings per share are good enough next year to warrant more gains on the S&P and the QQQs as well. So that is just my long thoughts on the matter. All these points, a little bit of market psychology and game theory for you guys. So if you enjoyed today's video, consider dropping a like on the video. Would appreciate it for the growth of the channel. Also consider subscribing to the channel if you're new. We do a ton of these videos. I usually put out a video a day, so feel free to check out more content on the channel. And lastly, guys, if you have any questions or you want to discuss this one, feel free to leave it down below in the comments and I'll get back to you in the next 24 hours. Take care, guys. Enjoy the rest of your holiday. I'll see you tomorrow after the market close. Peace.